Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to the 59th episode of Carson's Facts versus Feelings. Ryan and Sonu. Sonu, we're going to title this one, Why Stocks Just Bottomed. Now, we probably just upset a lot of people with that comment, but we're gonna dive in anyway. Now, so I'm getting older, so can I do a little rant for you before we even start? So my daughter is 16 today. We're recording this November 7th.
Happy birthday to her!
Yes, she's 16 today, and right before this, by the way, she didn't have school today. It's like perfect scenario because it's election day, and in Ohio, I guess you don't have to go to school on election day. So it all worked out that she has no school on her birthday, which is pretty cool. You think about it. Now, she loves Starbucks. She loves Starbucks probably more than she loves me, I'll be very honest. And she wanted Starbucks, so I took her to Starbucks. I never really go inside. I usually just let her go in. I actually went in with her today. I'll just say this much. Okay, yeah, the food's fine. It is a zoo in there. I can't do it. I get so nervous. It's like chaos. I got like, what did I get? A chocolate croissant. Thought it sounded kind of good. It's in a bag. They hand me the bag. It's got all this chocolate smeared on the outside of the bag. I touch it. I put it on my shirt. I'm like, you got to be kidding me. I said, I can't do it. I'm getting too old. I cannot go inside of a Starbucks. In the airports, they're okay, but boy, our local Starbucks is just crazy. So anyways, we're going to have a hibachi. Go ahead.
Lesson of the day, right? If ever you're hanging out with Ryan, don't hang him a chocolate croissant with smears all over.
Well, that's a good lesson. That's a good rule. Good rule, I guess, is what I should say. But yeah, we're gonna go out to a hibachi place tonight, and she doesn't even listen. She doesn't even listen to this podcast. If she does, hey, you're gonna get a car soon, okay? But she didn't even listen to it, so it doesn't matter. So yeah, we got a car. We ordered it on CarMax, right? It's like I'm following it. It's hoping it'd be here today. It's not. It's like up in Chicago. Sonu, can you just get it for me and drive it in today? Maybe later today. But she's gonna get a car soon. So maybe
what it is.
I would be so honored.
What it is, so I'm tempted.
Yeah, I'd be so honored if she actually listens to my podcast. I gave away she's having a car, but trust me, she's not going to hear this because I don't even think she doesn't care I have a podcast. But anyway, that's okay.
So I have a question on that for you. Are prices coming down?
No, I mean, yeah, as of this morning, I saw the Manheim used car index. The price is down 2.2% in October, but boy, it sure didn't feel like it to me. That's a good question there. Anyway, all right, so let's kind of dive in here. I mean, we're going to have a fun one. We're going to try to keep it about 30, 35 minutes or so. We're going to talk about why stocks likely just bottomed. We're going to take a look at what Jerome Powell had to say last week. Did he say anything really different? I don't know, but the market took it that way because the market took it dovish. You've got some really good data. You want to take a look at the unemployment rate, last week's payrolls number, which again sparked a rally on Friday at least. And we're going to end it with a really interesting discussion. One you're going to hear a lot from us probably going forward is a look at productivity. So let's start again with that stocks bottomed. I mean, a week ago right now, we're doing the podcast and we were in a market correction. We actually titled it Houston, we have correction, talking about stocks down 10%. Late October, historically over the top bearishness. We saw a lot of different things. We're going to talk about what sparked the rally really late in the week. Again, the Fed and the jobs number. But the bottom line, all 5 days last week were higher. As the time you and I are talking, the NASDAQ has a shot at being up 8 days in a row. The S&P's been up 6 days in a row. Lots of different ways to look at it, but I want to point out one thing called the Zweig breadth thrust. And we talked about this actually last April. Keep this real high level and simple. I'm going to do a blog. More. Yeah, I'm going to do a blog on it, carsongroup.com in a couple of days. So by the time you listen to this, you can probably see it. But simply put, it looks at how many stocks going up versus down on a 10-day basis. Okay. What you're looking for is really super duper oversold, okay? Oversold. And in 10 days, you get really super duper overbought. That's the easiest way to put it. We've had like 16 of them since World War II. 1 year later, S&P has been higher every single time. I think it's like 22% average return. So again, it's just one data point, I'm aware, but when you layer on all the over-the-top negative sentiment, you layer the fact that, hey, late October, I mean, the average year bottoms on October 27th. This year bottomed on October 27th. And we just can't make that up.
And your birthday is on October?
So October 28th. It's 28th, which was a Saturday this year. So I did not get which is actually historically the best day of the year. But anyway, all these different things layered on top of the fact that, listen, stocks just rallied big time. You got these breadth thrusts taking over. You got all this negative sentiment. My take is, you can't make guarantees in this industry, but I just think we had another classic correction in the fall, late October rally, and here comes the end of the year rally. You want to dive into anything I just talked about there?
I mean, it smells like 2022, last year, right?
Yeah.
I mean, feels like we were here a year ago, literally. By the way, is this number, what number podcast is 60, 15, 59?
59. I think I said that. And if I forgot, apologies. But I was thinking 16 in my head when my daughter's 16th birthday, but it's our 59th. So we've been doing these over a year now. And we just, how did it work?
We had charting. Yes, is that the word?
Yeah, Chartable. According to Chartable Research, which is a podcast data source, this podcast you're listening to, was just ranked for the first time. We were ranked number 170 out of all financial podcasts. According to Chartable data, we were ranked number 170. There are some really big podcasts ranked behind us, which was really shocking. So they must not go by total downloads. There must be other things that they look at, which is really cool. But we've done 59 of these, and our goal now is to become a top 100 financial podcast. So keep listening, and we'll keep doing them. What were we talking about, Sonu? I just went on a sidetrack. Oh, market rally, into your rally. What do you want to talk about?
Yeah. No, yeah, it kind of feels like last year, right? I mean, we had the same situation in a sense. Like, sentiment was really poor. Markets had just come off a massive drawdown. The S&P was down 25, yeah. 25%, something like that.
Yep.
And, now the key difference, right, which is, and of course, now is, but November is usually when a lot of investment shops come out with their outlook. And last year, almost everyone, not everybody, almost everyone is saying that we've been in a recession. Things are really dire. Sentiment is poor. It kind of feels like things are improving a lot up until July, and now everything's back to where it was last year. There are key differences, which I'll get to. I mean, Fed and all of that. I mean,
sure.
The outlook is very different, but from our perspective. But it feels like sentiment-wise, we're in the same place.
Yeah, not that different. And again, this was about a 10% correction versus a 25% bear market. Yet, if you look at put to call ratios, some flow data, some sentiment polls, you're seeing as much fear now. In fact, in some cases, more than we did in a 25% bear market, which is interesting. Wow. But here's what I thought is interesting. So today again is election day. So go out and vote. Or actually, by the time you heard this, it's not going to matter if you didn't vote or not. But hopefully, you went out and voted. But there's just the different stats and figures and things we talk about. We talked about this on this very podcast 52 weeks ago, that if you look at the day of the midterm elections and go out 1 year, since World War II, stocks have never been lower. That's the S&P 500. The S&P 500 1 year after that is up on average 14.1%. Sonu, this might blow your mind. 1 year since the midterms in 2022, take a wild guess. The S&P 500 is up 14.1%, the exact average that we've seen. And again, I mean, when we mentioned that and talked about why we thought, I mean, literally in the second week of November, we were out there saying that's the lows. I mean, people thought we were crazy. I remember going out on the road, doing it, talking at conferences. People thought we were crazy to say those were the lows. It is what it is. But you look now, remember a year ago, we were hearing about the yield curves inverted. LEIs were negative. M2, something called Quad 4, whoever knows what that is. I mean, there are different things that people were looking at that we just didn't believe. Yeah, we just didn't. We're like, no, it's not true. There is no recession coming. Things aren't great, but we're not just falling off a cliff. And here we are a year later, people were getting worried again, and we're still in that same camp, right?
No, exactly. And in fact, a big, let's say, drag on the economy last year at this time was the Fed. The Fed was raising rates like no tomorrow. Yep. They were raising rates by 0.75 percentage points every meeting, from July all the way through November. In fact, a year ago, I think it was their last 0.75 percent point rate hike, right?
Yeah.
They're not doing that right now. They're not. They just paused. They paused since July. That's a big difference.
Well, it is. I mean, you hike 11 times, up almost 500 basis points, and that'll, upset some of the apple cart a little bit. But now we don't have that. We don't have that at all. I mean, just some things. Again, we mentioned this last week, but maybe just a couple more contextual things to be aware of. November, again, when October's down, like it just was. And again, I want to be clear about something. We were on record a month ago saying we thought October, the early lows, remember the October, I forget exactly, 3rd, 4th, 5th around, we thought those were going to be the lows. We thought those were the lows. Market bounce, and we are aware it rolled back over. So a little egg on our face, you could say, potentially, because we thought those were the lows. But here's what I want to point out, that the terrible war that happened in the Middle East sure didn't help things from that point of view. But also something I think is important people to realize. There's something called a bang and a whimper. That's what we look at from a technical point of view. bang means boom, the big drop. Whimper is you kind of go up a little bit and then you come back down and maybe test it, maybe just break it. But here's what you're looking for. There were more 52-week lows on the NYSE, on the S&P 500, on the Russell 3000 back in early October than when we just broke those lows, about a week ago or a week and a half ago or so. So more lows, even though less lows, even though price made a new low. That is what you tend to see at major lows. Look at 87 crash in October. Most people think 87 crash October. Stocks bottomed in December of 87.
Right.
But way more stocks made 52-week lows back in October than they did December. And I can list a lot more of these examples. I mean, October 2002, March 2003 is another one. And there's more, believe me, even a year ago. I mean, a year ago we had it. So you see these bang and whimpers. We're seeing it again. And it's just something to really be aware of, that there's some technical improvement under the surface. And if all you looked at was market in a correction and we broke the early October lows this time a week and a half ago, you might have, you'd miss. You'd be missing some of the information that's out there if you don't peel back that onion all the way. You want to add anything there?
No, I love that term, bang and a whimper. Basically, it seems like there's no follow through. Right.
Yeah.
I mean, everyone, done with the selling, and then there's no more people left to sell or be really pessimistic.
Mm-hmm. And let's be honest, from a sentiment point of view, it is pretty demoralizing when you think the early October lows were it, and then you break them. And I mean, we've been bullish, and that was demoralizing. Oh, here we go. We made new lows again. What's going on? And we laid out why we were still optimistic, but I don't care who you are. It still was a gut punch, And then you have a week like last week where the S&P gained 6%, small caps gain even more. All the stuff that happened, happened. But I mean, we're going to move forward. So anything else you want to talk about? I guess some of this is so connected. It's so connected to what we're about to talk about. Go ahead.
I'm still amazed by that number, but that average number since last midterm. Yeah.
Yeah.
Midterm election, 14.1%. I mean, one of my favorite charts amongst the multiple charts you put out is the one that shows that no year is average. But, here we are. We're bang on the average. That's amazing.
No, you're right. Maybe I'll point it out again because I know we have a lot of financial advisors that listen to this podcast. And, the average year gains about 9% for the S&P. But you go back since 1950, so over 70 years, only 4 times out of over 70 years has the S&P closed between 8 and 10%. So you call that about average. Only 4 times. So average isn't average. Literally, a week or so ago when we're flirting with about a 8% gain for the year, I got to thinking, I said, man, either we're maybe going to drop a whole bunch or we're going to see an end of year rally, because it wouldn't be normal if stocks were up about 9 or 10% for the year. You get those swings. And fortunately, as the time you and I are speaking, about 15% total return on the S&P, give or take. And we're still optimistic. There's still more coming. All right, Sonu, so let's kind of move forward, because again, a lot of this stuff's connected. My question was going to be, what could spark the end of year rally? And I think maybe we're getting a sniff of it. It potentially the Fed turning a little bit more dovish. We had an interest rate decision last week, widely expected. The Fed is holding pat last week, but now it sure seems like the markets catch going. You and I have been talking about that. Hey, inflation's coming back, economy's strong. They don't need to keep hiking. They might even can cut sometime late next year. We'll get into that, or middle of next year. Why did the market react so positively to the Fed this time? Because I'll be honest, I didn't think it was that different than what he said 6 weeks ago. What'd you think?
I didn't either. It was mostly during the press conference, right?
Yeah.
And look, they had their meeting last week, and they didn't rock the boat. They kept rates steady. Literally everything that was in the FOMC's, the Open Market Committee, their statement was, it wasn't very different from what we heard before. Powell didn't say much, anything different either in his official statement, right, just before the press conference. But then, during the Q&A, a reporter asked him, look, you all have penciled in one more rate hike in 2023. What do we do with that? Right? Is that coming? And then Powell went on to say, he kind of downplayed that fact, right? He said, you know what? Well, for a practical purpose, he basically said, ignore those projections, right? He said the dot plot, their projections for what comes in the future, its efficacy drops in 3 months, right? And he said the FOMC members can change their views in 3 months, right? So the markets are already pricing in no more hikes, right? Markets didn't believe the Fed, so to speak. And Powell literally didn't do anything to shift that expectation. He had every opportunity to do it, right? They definitely follow market expectations. We know that. They don't ignore it. But look, I think their view is they've done enough. Now they want to wait and watch. Risks are balanced. It's not like last year. We were talking about the comparison to last year. Last year, the risk was mostly one-sided. The risk was that they wouldn't do enough to curb inflation. Now there's a risk that they do too much. They could over tighten. They're very aware of that. I think that's huge. That's positive.
Let me jump in there. Wouldn't it be something if the Fed, made the wrong move or went too far one way or the other? Given, of course, I'm joking there. I mean, I saw some things from our friends, Fund Strat, right? Tom Lee, friend of the show, obviously been on the show before. I'm pretty sure Tom said along the lines of used cars equated for about 2/3 of the huge spike in inflation that we saw, middle of 2001, 2002. Yet this morning, the Manheim Used Car Index did come in down 2.2%. It's negative year over year, Sonu, 14 months in a row. If used cars were one of the bigger reasons we had issues with inflation, and that was a big reason the Fed was so aggressive, let's be honest. There are other reasons, I get it, but used cars were a big chunk of that. I mean, used cars, I think, go up, 40% year over year at one point near the peak. I mean, that's incredible. Now it's not a headwind anymore, right?
Yeah, no, look, I think what the Fed wants to see, and this is another important thing Powell mentioned, right? And this they've been saying for a while now, they've disconnected the labor market, what happens in the labor market and the economy, to be honest, from what happens in inflation. Because what's happened, right? Over the last year, GDP growth has accelerated. The economy has done really well. It's up 2.9% since, Q3 of last year. Just last quarter, the economy, economic growth was 5%, almost 5%, right? And the labor market is pretty strong. I mean, we'll talk about unemployment rate. It's at 3.9%. But, Powell said that's okay, right? We're not worried that will lead to inflation because during this time, when all this has happened, inflation's gone down. Inflation's gone down from a peak of 9% to under 4%. That's huge, right? And then you look at core inflation, like you said, a big part of it is used car prices. That's still coming down. By the way, we shouldn't completely ignore headline as well, because all of us, literally everyone listening to the podcast, you and I, we experience headline inflation. We don't experience core inflation, right? I mean, the Fed focuses on core inflation because they think that's what's sticky, that's the trend. But, gas prices are coming down. That's going to be huge. I mean, gas prices are close to $3.90 a few months back. It's down to about $3.40 right now.
So I've got CNBC on before we started this. I'm pretty sure I heard CNBC say, don't quote me here, I'm pretty sure I heard this. So the gasoline price is like the lowest this year, right? It's like the lowest this year right now is the cheapest time to fill up your car. I know I filled my car up last week and it was one of the lowest numbers I remember in a long time. So again, those are just, okay, there's an extra $20 I didn't have this time 2 months ago, give or take. So
more money for your daughter.
I was thinking, what would I spend my $20 on? I don't know. If I had $20 and no one knew what I was going to do, I'd probably get some
Starbucks
somewhere. I don't know. Starbucks.
Chocolate croissant.
No, maybe not so much. Speaking of that, I mean, Sonu and I had fun in Chicago. We were in Chicago on, you live there, so you were there more than I was. I flew in on Sunday. I did an event on Monday this week with NAME, the NAAIM, a really great organization. Had a lot of fun at that event, getting to speak and met some really big time people in the industry. But Sonu, you and I had a nice dinner, watched my Cincinnati Bengals win a game as well on Sunday Night Football. And let me just tell you that the steakhouse we went to did not look like a recession was coming, did it?
No, and we did get a little bit of dessert too. Which
a little bit of dessert. You guys, maybe you hit us up privately, a DM or something on X or whatever. We'll send you a picture. The desserts. Did your kids eat it? We got 2 pieces of cake. If you've ever been to Gibson's in Chicago, look at their desserts. It's unbelievable. It's unbelievable. Are your kids eating that for like the next month? I mean, that was right after Halloween too. Goodness gracious. Yeah.
Lunch for me yesterday, lunch for me today, dessert for the kids yesterday, today.
Man. You doing the chocolate or the carrot cake? This is only between Sonu and I now, but which one do you both? That chocolate was so good. Oh my goodness. Anyway. All right.
That's insane. I think that was bigger than my kid's birthday cake.
No, 1 piece. Yeah, go to Gibbs in Chicago if you want. But again, get 1 piece of cake. It feeds 6 people. We are dead serious. Anyway, all right. So that's probably enough about the Fed. I mean, the Fed is likely done. We've been talking about. Let's talk about the jobs number, because that was the other big thing that came out on Friday, and it kind of runs along with the Fed here. What I heard was the jobs number was a little bit weak. We heard, if you look at the household employment survey, it's showing problems. I think I heard somewhere that the jobs number has been revised lower. Maybe it's 9 or 10 months in a row. People are poking a lot of holes in that number, seeing the economy's really dropping. And if you look at yields really dropped on that. I mean, but the market rallied. Let's be very clear. So sometimes that's what I care about more than anything, is how the market reacts to it. What was your take on that jobs number? Was it really as bad as people made it sound?
No. Short answer.
Right. I figured you'd say that, man.
Sorry, it's collecting my thoughts here, but
you're thinking of lunch. I know I am too. We're thinking of you. Thinking
you
of
got
that big old
the
Sorry.
cake sitting upstairs in my refrigerator. That's what I'm thinking about. Look, the labor market is slowing down, right? And it was a disappointing report, but you talked about markets going up, right? We've been in this dynamic since July, probably through October, till this labor market report, till this payroll report came out. That good news is bad news, right? Good news, good economic data news. Interest rates go up. Stocks don't like that. Stocks go down, right? That's literally a dynamic we've had. Now we got some disappointing economic data, and it was disappointing I don't mean to minimize it, right? But then interest rates went down, and stocks like that, right? I mean, so there is this bit of yin and yang that's going on, right? Which is not to say we want to see. Look, you and I have talked about this. Good news is good news. Bad news is bad news. Now, I just don't think this payroll report is really bad news, right? I mean, look, like I said, the labor market is slowing down. All recessions are preceded by slowdowns. But here's the important thing, right? All slowdowns don't have to lead to recessions, right? Job growth in October came in at 150,000. Expectations are 180. But look, the UAW strike, which has ended, by the way, that pulled payrolls down in October by 30,000. We also have the actors strike. That's keeping payrolls depressed by about 16,000 or something. And that's why you talk about revisions. And you never want to take the 1 month number at face value, but you can take a 3-month average. So the 3-month average is at 204,000. And 7 months ago, we were at 300,000 up until March. So things have slowed, right? But 200,000 is still very strong. Before the pandemic, we were averaging 180,000, Ryan. To keep up with population growth, we need about 100 to 125,000 jobs a month, right? So 150,000 is not bad. 200,000, I would say, is very good.
So let me ask this, and if the number came in at 150, expected 180, I mean, maybe you mentioned it, but I want to dive in again. How many jobs likely were impacted by the UAW strikes? What would if we never had a strike, what would that number maybe come in at, you think?
The UAW strike specifically pulled payrolls down by about 30,000.
Okay.
So it would have been about 180 or so.
Okay. So let's go to the next step then. So things are slowing. No, let me rephrase this. Things are normalizing, maybe slowing a little bit, but more normalizing is one of our big themes. You've written and talked about this a lot. Really great stuff you've done on that. Just the idea that we're more normalizing here. Hey, we're still making 200,000 jobs. I know last month wasn't 200,000, but overall we're averaging. What did you say we're averaging? I wrote it down. 204 the last 3 months. So we think that can continue.
Right.
Let me ask you though. Unemployment rate. This is something that has clearly been out there. Unemployment rate, I've got it written here. I know you know it. It ticked up to 309. 309. Where'd that come from? 3.9. 3.9 versus 3.8. It's been ticking higher. Now, there's something called the SAM rule, and I'll let you explain it, but a lot of people are throwing out the SAM rule, S-A-H-M. You might hear this a lot going forward, and it potentially, if this rule were to trigger, it would mean not that we're going into recession, that we're in a recession. Like it's happening right now, which would be quite interesting with all the other economic data that is not saying a recession. But it hadn't triggered yet. I want to be clear, but people are saying, hey, be on the lookout. It might happen soon. You want to talk a little bit about that? Because I know you've got some really good thoughts.
Yeah. So the unemployment rate, anytime the unemployment rate, I don't want to sugarcoat this anyway. It's concerning if it goes up, right? And it's moved from a low of 3.4 to 3.9%, right? Now, let's see. Let's put that in perspective. And let's talk about the SAM rule, right? So it was developed by this former Fed economist, Claudia Sahm. She's fantastic, by the way. And what she developed is, look, it's an empirical observation, right? It's an observation. It's not it's not like gravity is a rule, right? I mean, if I drop
and I getting cake for dessert is a rule. There are certain things you live by. Yeah.
This is an empirical observation, and kudos to her. This is what she developed, right? What she said is that if the 3-month moving average of unemployment rises by 0.5 percent points from its prior 12-month low, then the economy is in a recession. Right now, Ryan, the 3-month average of unemployment, the unemployment rate, is 3.83%. The prior low over the last 12 months is 3.5. So the SAM rule indicator, so to speak, is 0.33%, right? And she says if it's at 0.5% or above, it's triggered. Right now, it's not triggered. But if it is above 0.5%, that means we are in the middle of a recession, or the recession has started, right? That's what it is. So I know there's a lot of panic. So basically, here's some more perspective. For the SAM rule to trigger, we'd have to see the unemployment tick up to 4% and stay there for November, December, and January.
Okay.
Right? That's the earliest probably it would trigger. Unless, obviously, it could also trigger if the unemployment jumps from 3.9 to 4.3% next month. But I don't think that's likely to happen, right? So just to put some context around the SOM rule, right? But let's talk about the unemployment rate real quick, right? Now, the other part, and I was looking at this, I send a daily note out to our advisors. And I was trying to figure out, okay, why is the unemployment rate rising, right? And especially when other parts of literally the payroll report, right?
Well, like claims, right? Claims aren't really soaring. I mean, they've ticked up a little bit, right? But they're not soaring higher.
Yeah, they're around 215,000, which is really low, right?
Yeah, they were under 200,000 not that long ago, but it's all, you get these bounces. Yeah.
And here's the thing. Over the last year, Powell's not talked about this as much, but he's basically said, look, he's worried about inflation, but he's looked at it through the lens of the labor market. He said, the labor market is very unbalanced, right? You have a lot of demand, but you don't have a lot of supply. Here's the thing. We've seen a lot of supply coming into the labor market. Labor force growth. So the labor force, right? The number of people basically looking for work, that's literally how it's defined, plus all the people working, right? That's grown by 3.1 million over the last year, Ryan. And it's grown 6 million over the last 2 years. That is a massive jump in labor supply. It's growing at a pace of about just under 2% year over year. Now, obviously, what does that mean, right? Let's compare it to before the pandemic. Between 2017 and 2019, the labor force grew by 5 million. Over the last 2 years, we've done 6 million. Before the pandemic, 3 years before 2017, 18, and 19, the labor force is growing at 1% annualized growth. Right now, we are printing close to 2%, right? So that's almost 2 times the pre-pandemic pace. So a lot of this is immigration too. Immigration is higher, so that's why, we're seeing that big jump. And a lot of people are coming into the labor force. That's a good thing, right? Because a lot of workers coming off the sidelines, they're looking for work. That tends to happen in strong labor markets. I mean, you wouldn't look for work if you thought the labor market is weak, right? That's what happens during recession. The labor force tends to shrink, right? Because people just leave the labor force. So I think that's and a lot of people are coming in, but hiring is normalizing, right? A lot of employers hired a lot of people over the last couple of years. They're like, you know what? Now we just want to let's make that work, right? Let's not go out and hire like crazy. So a lot of people are unemployed.
Good points there. And we talked about this before. Our economy created nearly 5 million jobs. I think we were there. There may be some of the revisions, but we're right about 5 million jobs created last year. We're going to be somewhere between 2.5 and 3 million this year, give or take, depending on where things go. Bottom line is you just don't have recessions, right? When you're doing that. Right. Now, one thing, I mean, we need to wrap this up here in a couple minutes, Sonu, but you did some really interesting work on layoffs also. You looked at layoffs, but let's be honest, if the economy was spiraling out of control, employers were worried about where things are going. Layoffs would be soaring. I mean, remember earlier this year, we had some big tech layoffs. Remember some of all the Apple, Google, Microsoft, all the big names laid some people off, and everyone got really worried. We said then, we're watching it. Make it more tech specific or that area specific because they grew so much during the pandemic that sadly they were just trimming some of the fat. And looking back, that was exactly what happened. What are layoffs looking like now? I don't think we've seen big surges, right?
No, actually, layoffs are running really low. It's about 1.5 million people. By the way, a lot of people get laid off every month, right? So this just gets to something Sam Rowe talked about when he was on the podcast. So
I've been laid off twice, and there weren't recessions.
There weren't recessions. Right?
It's unfortunate. It happens.
Right. So when you talk about payroll growth, it's a number of people getting jobs minus the people leaving and laid off, right? Like separations, basically. So layoffs are running at 1.5 million, as I mentioned. Before the pandemic, Ryan, it was running at 1.8 million. But keep in mind, we have a bigger population, bigger labor force now. Yeah. So as a percent of employment, the layoff rate, right? Number of people laid off divided by the number of people working. That layoff rate is at 1%. Before the pandemic, it was running at 1.2, 1.3%, right? Just some perspective for you. Yeah. By the way, the unemployment rate, yes, it's risen, and that's not, you don't want to see that, right?
Sure.
Since the end of 2022, I was just looking at it. The unemployment rate has gone up from 3.5 to 3.9%, right? But, I like to, you and I have talked about this. I like to look at the prime age employment population ratio, right? That's because that sort of controls for demographics and labor force participation, right? It's literally the opposite of the unemployment rate, right? Except it doesn't have several definitional issues. that's at 80.6%, which matches the pre-pandemic peak, right? It's down a little bit. It's down from 80.8%, but not too concerning. Since the end of last year, so I just said the unemployment rate went up, but the prime age employment population ratio has gone up from 80.1 to 80.6%. That's a good thing, right? So again, that's a lot of stuff going on.
A lot going on there, but that's great. A great way to look at it. It's not just so simple. I mean, we've heard, people aren't saving anymore because saving rates are lower. They're strapped because of credit card debt. And then you look at money markets just soaring with $6 trillion. It's like, hey, listen, I don't know, is that considered a savings account or not? But people are still have some cash sitting there. And again, this is a whole nother can of worms. But that's really interesting when you look at the unemployment rate versus the prime population and prime workers that are out there. Participation rates, what I'm trying to say there. Good stuff there, Sonu. So a lot of P's all of a sudden. We're going to end with one more. Productivity. We're gonna talk a lot about this going forward. So I think we're just gonna start to lay the groundwork. By the time everyone's listening to this podcast, you can go to carsongroup.com and click on Insights and get to our financial investment blog. And there should be a blog up on productivity. But Sonu, I think this is really interesting. I think maybe the first time we've talked about this, or at least really going to dive in for our listeners. But you've got some really unique takes that productivity hasn't been great for a while, but it's starting to get better. We got a really strong productivity print last quarter, and I think annualized 4% the last 2 quarters. So productivity is starting to come back. If we get better productivity into next year, kind of what does that mean for the economy, for inflation, for wages, for this bull market to keep going? How does it all hinge on productivity, so to speak?
It's so important. It's probably along with labor force growth, right?
Yeah.
The most important thing is productivity, because real economic growth is basically the sum of productivity plus labor force growth. That's basically what it is. We just talked about labor force growth. That's positive that people are going back in, right? Productivity is the other piece of it. It rose 4.7% Q3. And that comes on top of the second quarter is 3.6%. As you mentioned, productivity over the last 2 quarters running about 4% annualized, right? But that took it above the 2010 to 2019 trend, right? Now, since 2020, productivity is running about 1.4% annualized. But between 2010 and 2019, it was running at 1.2%. So it doesn't look too different, but it's slightly higher. But it hides a lot of things, right? So you take 2020 to 2023, right? So initially, productivity jumped in the second quarter of 2020. And you think, wait a minute.
I wonder why. Because if you had a job, you were literally working 3 times as hard. So you had to be more productive if you wanted to keep your job. That's the summary, right?
Literally. And that happens during recessions and immediate recoveries, right? So output starts to rise, but hours worked remains low because a lot of people are out of their jobs. And even in 2009, Q2, second quarter 2009, deep recession, productivity rose 9%. But these are all like our friends at Employ America, Skanda Amarnath likes to say, these are empty calorie gains, right? It's not like the productive capacity of the economy has increased, right?
Is a chocolate cake empty calories? Is that
no?
It didn't. When I went home after that dinner, I just laid on my bed, and I actually fell asleep during the third quarter of the Bengals game because I ate so much food I couldn't even stay awake. So they might have been empty calories or full calories, but it did put me to sleep during the third quarter of the Sunday night game. Sorry, Sonu, to jump in. I just wanted to point that out.
No.
But, empty calories.
Empty calorie gains, right? And that's literally what happened in 2020, 2021. Remember, the economy recovered to its pre-pandemic pace by middle of 2021, and we did that with 8 million fewer workers. Right. So workers are really getting squeezed. But that kind of productivity increase only lasts so long. People started getting hired again, right? And then, that they have to be trained. They have to be retrained. You had a lot of churn in the labor market, a lot of workers moving around. This is not a period when productivity goes up. It goes down, right? And that's what we saw in 2022. Productivity started to fall, right? And by the way, this also relates to what happened in the 1970s, right? You had demographics. You had a lot of baby boomers coming into the workforce. And as they got hired, you basically got low productivity, right? So that was the option in the 1970s. You got either low productivity or mass unemployment. And we got, a lot of people are employed, but you got low productivity. And that's one reason we had inflation, right? But what's happened, and I'll come to that piece of it. But what's happened over the last 2 quarters, the good part is we've had a massive increase. Like I said, 4% increase in productivity over 2 quarters. That's the largest 2-quarter increase we've seen since the late 90s.
Wow.
Outside of these recessionary periods. The recessionary period productivity gains are artificial, right?
So during
But
the
right
good
now,
calorie
yeah,
times is what we're saying.
good
During
calorie
good
times.
calorie
Yes.
times, this is the best since late 90s. Okay.
Right. And why is productivity increasing, right? Businesses have started making investments, including labor, right? Labor is business's biggest investment. They hired a lot of people 2021 to 2022. That's bearing fruit. That tends to happen during a tight labor market, right? Which is what happened in the late 90s. Higher wage growth means firms are more incentivized, Ryan, to make productivity enhancements. They organize work more efficiently. There's buy more tech, all of that. Workers are also incentivized to be more productive, right? So you can, and it also forces less productive firms. Like if you have strong wage growth, right? Some firms are like, oh, we cannot pay that, and they may go out of business, but those may be less productive for firms. So as the less productive firms go out of business, it can boost overall productivity in the economy.
Yeah, I remember you sent this note to our Carson partners the other day, and I thought that was really interesting because if everybody else is productive and you're not, you're probably going to go out of business, and that's not good for that particular situation, but for the overall economy, for more productive companies and employees and employers to take over, that's impressive. So again, we don't want to give. Go ahead.
I'll do a couple of minutes more just to connect why this is such a game changer for the Fed and really the Fed. Right? Because it ties to inflation, right? Because wage growth, if you think of a strong wage growth is actually productivity plus inflation plus the change in labor share, right? How much of total income is, a worker's taking versus, businesses, right? It's the opposite of profit margins. So you can have faster wage growth because of faster productivity or higher inflation or an increase in labor share of income or lower profit margins, right? Or some combination. Now, what happened in the 70s, as I said, productivity was low. Wage growth was running about 9% annualized pace. Just think about that. Wage growth was really hot in the 70s. That didn't translate to productivity increases. Instead, businesses just passed on price increases. And that's why we got inflation about more than 8% during that decade, right? 73 to 82. Take the period from 96 to 2004. Wage growth was running hot, 4 to 5%. But inflation, Ryan, averaged just 2%. Just above 2%. So you got real income gains, right? And that's because productivity surged to above 3% a year. And you had a tight labor market during this time. So it's this feedback loop between productivity, policy, and tight labor markets. So, you get strong productivity growth, you get low inflation. That can lead to the Fed saying, you know what? Maybe we don't have to keep rates high. We don't have to keep interest rates high. That can lead to more investment. It could lead to lower unemployment, faster wage growth, and even more productivity growth. And that could signal to the central bank they can drop rates further, right? So,
no, amazing. No, it's a really interesting conversation. We're definitely going to dive more into this going forward. Just maybe to wrap it up, 94, the Fed hiked rates aggressively. February 95 was like their last hike. Then the market sniffed out the Fed was going to start cutting in late 95, which is exactly what happened. If you look back in history books, 95 was a really bullish year, but so was 96, 97, 98, 99. We were aware. And again, that was one of the last times we had really strong productivity on good calories, as we're going to call it.
Calories.
So definitely really interesting conversation. I think we're kind of at the end of the road here, Sonu. Any final comments from you? And then I'll bring us home.
No, I think I'm looking forward to the next 2 months. I mean, November, December for markets and really next year. I mean, between productivity, all of that, I think there's a lot to look forward to.
Well, I love it. That's great. Let's hope there is. And I'll just say this. It's really warm right now in Ohio, and it was warm in Chicago. And it was warm the week before Halloween, yet Halloween night was like freezing all around the country. I don't know. Maybe we need to be more productive next year and just pick a warmer day for Halloween so we're not out there freezing when you do Halloween. It's just funny. Like every day was nice except for Halloween the last 2 weeks. So hopefully wherever you are, you're enjoying a nice fall day. Thanks again for making us the number 170 ranked financial podcast according to Chartable's data. We really appreciate that on the Facts versus Feelings podcast. We'll keep doing them if you keep listening to them, and that's a lot of fun. So here's to a productive, like the way I did that, Sonu, here's to a productive rest of the week, and hopefully a real productive next year as well, which could help bring a lot of things together to keep this
calorie
gains, keep this economic recovery going, keep this likely bull market going, keep earnings continuing to grow, and all in all, we're still pretty optimistic that things are going to look a lot better into the future. So with that, we will see everybody next week. Take care. Thank you. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.